On today's episode, we're going to talk about the market update and we're going to really focus on inflation. My podcast was designed to help new and seasoned investors and entrepreneurs break free from financial confusion by sharing real world investing and business strategies they can use to build lasting wealth and freedom. Well, we've got a lot of articles to go through today. I've been for the last 2 weeks or 3 weeks gathering a lot of data, things to talk about, and we're going to really hammer on inflation today. CPI numbers just came out yesterday for May, and a lot to talk about there. But I want to start today with a continuation of something that I mentioned on a previous episode. Wall Street Journal article out. Let's see, this was out June 6th. The article is SEC weighs further loosening of rules barring retail investors from private funds. Now, I talked about this a little bit a couple of episodes ago. I had seen an article in maybe Fox Business, I think it was, talking about this, and I believe it was the SEC director at the time, don't remember the gentleman's name, had talked about it, just kind of hinted a little bit that they were looking to change the rules regarding the accredited investor being the only ones that could invest in private funds. So when I ran across this article, I thought, is this the same thing? Are they quoting the same thing? And they were not. Now, this time, in this article, you got to dig almost to the end of it to get to the good stuff. But in this article, SEC Commissioner Hester Pierce recommended eliminating the limit to allow retail investors, that is, people who are non-accredited, greater access to private investments through closed-end fund wrappers with the benefit of professional management. Now, that really doesn't affect us in the alternative space because what they're talking about here is large Wall Street funds that right now, to be quite honest, are having a challenge raising capital. So the administration in Washington now is trying to open the door for these funds. Now, these are the big boys. These are the Black Rocks, the Vanguards, the KKRs. These are the big guys, the Apollos, multi-billion with a B dollar funds. Now, that's not the sandbox I play in. Our largest fund has 135 million with an M in it, nowhere near billions. So this does not affect me until the very next sentence. And here's the sentence. Pierce, a Republican SEC commissioner since 2018, also said she would like to see more meaningful expansions of the accredited investor definition, as would many retail investors who resent being cut off from an increasingly large segment of the market. Wow. Okay, there is a lot to unpack in that one or two sentences. So what she said there, after this entire article is talking about these huge multi-billion-dollar Wall Street funds, and they want to allow non-accredited investors access to these SEC-regulated, professionally managed Wall Street funds. That one sentence, though, did not talk about those funds. That one sentence said they want to meaningfully expand the definition of an accredited investor. Now, taking this lady at her word, that would affect me. That would affect all of us in the alternative asset space who are raising capital. So, for those of you that don't understand what an accredited investor designation is, it is a designation that the federal government gives through guidelines, not law, that simply says you can make the accreditation status by having $1 million net worth, excluding the value of your primary residence, and by hitting a certain income threshold. And don't quote me on these thresholds. I'm not the one that handles this in our company, but I think it's like 200,000 filing singularly and 300,000 filing jointly. So if you hit one of these three benchmarks, you are then deemed an accredited investor, and you are allowed access to investments that non-accredited investors are not allowed access to. One case in point, we have two funds that are Reg D Exemption C funds, our ILS Growth Fund and our ILS Income Fund. Both of those funds, being Exemption Cs, mean we cannot allow anybody who is not accredited to invest in those. Well, that's a challenge for people that are close to accreditation. I have a lot of friends in real estate that would love to invest in them, but maybe they're not quite to accredited status. And we also have a lot of accredited investors that are invested with us that want their family members, their friends to invest with us. And again, they're not quite at that accredited status. And we are just one of, I don't know how many, but probably hundreds of thousands of investments across this country that fall in those categories where we can only take accredited investors. So this is huge for our industry if indeed the SEC follows clear through with this. So it is something that we'll be watching, and as I see more and more articles on it, I will bring that to you. I really want to hammer on inflation today with the CPI numbers coming out. But first, I found another article I thought was very interesting in Bigger Pockets. This is a June 9th article, and it says a list of the 141 markets where prices are falling. Now, that's the headline. All 149 markets where prices are falling. Now, this was kind of fascinating because they take a look at just under 900 markets all across the country, and they watch the prices, whether they're going up or down year over year and month over 3 month. And they provide in this article a heat map of where prices are going down the most. You know, the darker the circle, the more they're falling, and so forth. And I just thought it was very fascinating. Nationally, prices on homes across the nation are up 1.4% year over year. But of course, we all know, if you're listening to this, there is no such thing as a national real estate market. It's a whole bunch of tiny little local markets that are aggregated together to make national numbers. And of those 900 markets, or almost 900 markets tracked, 141 of them saw year-over-year declines. 141 saw year-over-year declines. Now, I dug a little bit into it because I'm a geek for this kind of stuff. And 17 of the top 20 falling markets were in the South. We had Mississippi, Texas, Florida, South Carolina, Arizona. There were a couple in New Mexico, Louisiana, and one in California. That rounded out the top 10 markets the top 20 markets where prices have been falling year over year. Now, I dug into it a little deeper, and I said, well, where are these markets? Because a lot of them were in Texas and a lot of them were in Florida. And, you know, the Texas markets, we had Big Spring, Texas, which, by the way, there's nothing big about Big Spring, Texas. It's a tiny little area. Vernon, Texas, Pecos, Texas, Sweetwater, Plainview. These are all the Texas towns or Texas markets where prices are falling. So I looked them all up on a map because most of these, I didn't even know where the heck they were. And basically, they're all West Texas, Southwest Texas. They are tiny little towns, very small areas. They are not close to any major metros. None of them were. Then we had a couple New Mexico's Silver City and Teos, New Mexico. I may not even be saying that correctly. Eureka, California. Eureka is up by the redwood forests, way up in Northern California, not close to any large metro areas. But then we had Florida, and that one was interesting because we had in the top 20 places where prices are falling on single family homes, we had Punta Gorda, Cape Coral, Northport, Naples, and Panama City. All but one of them are in a row on the Gulf side of Florida. The only one that isn't, obviously, is Panama City, which is just around the horn up on the Panhandle side of the Gulf. And all of those are in major metros. So I thought of all of these 20, the Florida ones were the most interesting to me because these are actually real markets. Okay. These Texas markets, these are just tiny little Texas towns. They're not really large markets of any size. But you're looking at Punta Gorda, Cape Coral, Naples, Panama City. These are real markets. These are sizable, substantial markets that had fallen. Now, here was the last thing that I'll share with you on this. 141 markets fell year over year, but 339 fell over the last 3 months. And as I dug into those, the top 20 were still in those same areas. There was one Illinois, Malcolm, Illinois, again, a tiny, tiny little place, did pop into the top 20 that we didn't have any Illinois in the year over year top 20. So that's kind of what's happening there on the drop in real estate prices. And it just goes to show what we say all the time. There is no such thing as a national real estate market. It is made up of a whole lot of small little markets that are aggregated together a lot of times by news media and information technology folks. And they tell us what a national number is, but it really doesn't tell us anything. Okay. There were some markets that have actually increased in value, and those were tiny little markets in the north where values were increasing substantially. So that kind of gives us a little look there at housing prices this month. Listings, just for a point of reference, are at the highest since March of 2020 when the shutdowns happened with COVID. We have 1.94 million listings. That's up about 16.5% year over year. We also see that Redfin's reporting home sales fell 3.5% month over month and 2.7% year over year. So housing listings are up, sales are down, transactions are slowing down. And Redfin, of course, asked everybody why. And these were the top reasons: high prices, high interest rates, tariff and recession fear, and higher insurance costs. Now, I might also throw in there that property taxes are going crazy in a lot of areas too. And I think from a long-term rental standpoint, that's another point of pain for people that are trying to build a portfolio of long-term rental properties. But high prices, high interest, and tariff and recession fear, of course, were the top of the list. And we're going to talk about recession fear as we are talking about inflation and we get into that data. Before we do that, one other thing to talk about was there was a big conference out in Vegas just a few weeks ago. And this was the ICSC annual conference. Now, ICSC stands for International Council of Shopping Centers. And this is something that's interesting to me, and it should be interesting to anybody that's in commercial real estate because retail is a very large segment of the commercial real estate space. And the ICSC is like it's like the biggest thing in retail space. every year. I think 25,000 people showed up this year. And unfortunately, I was not able to be there this year as I typically am. But some of the highlights that came out of a Marcus and Milchap Real Trends webcast that came out June 4th, I was able to catch that webcast. And a few things of note that came out of there. Retail rent growth is still extremely solid. And that really tracks with what we're seeing with our shopping centers that we have and manage. We're seeing rent growth um, is really good right now because demand is high and supply is low. I mean, it's Econ 101 again. It's the number one rule of economics. There has not really been a lot of shopping centers built in this country since the 1990s, really. And as a result, there's been a lot of rent growth there, and we think there's a lot of room for that to grow. So did the panel on this webcast. They felt the same way. The I guess the other thing that I got from that webcast is there is a lot more new construction in the shopping center space in two states, and that is Florida and Texas. Because Florida and Texas have been growing in population and growing in, new subdivisions and new areas being built out. Obviously, there is new supply being built in those areas to service those new homes or roofs, as we call it in the industry. The rule in retail is first you build the roofs, then you build the retail. So as new subdivisions are built, there are most generally plans and sections of land that are left for retail, but nothing gets done in there until those subdivisions are, fairly occupied, fairly full of new homes with families living in them. Then you start seeing that retail build out in front of those subdivisions. And that is still very strong in Florida and Texas, but that's really about the only two places that this panel is seeing large amounts of new stock. And that new stock really does not affect old stock because the geographic area that is serviced by a retail center, whether it's a shopping center or a strip plaza, is relatively small. Unless you're out in a rural market or a really small tertiary market, you're looking at usually a 1 or 2 mile radius of service. So if, in the Houston Metroplex, which is where I'm sitting right now, a new subdivision is built out on the outskirts of town, it is certainly not going to affect when they put their retail in out there, anything that is already existing in other areas. So the last thing I'll say on this retail sector is that, interestingly, one of the ladies on this webcast had mentioned that capital has been significantly flowing into the retail space. And she made a comment that bids or bid sheets for lending on retail shopping centers is now back to or even higher than 2019 levels, which I thought was fascinating there. So that is the update on retail. Now, let's get into inflation for a minute. And, we've got the CPI that just came out. And I'm going to read a little bit from I just picked any news organization here. I picked CBS. I wouldn't typically, but it was the first one that popped up when I did a Google search, and the numbers are going to be the same on any of them I look at. But the spin is usually different depending on the news agency that you pull. When you look at inflation reports, as I do every month, and I look at multiple sources, the spin is pretty much the same right now on inflation. And we're going to talk a lot about that because The name of this is the invested mindset. So we're going to talk about the mindset behind inflation, and that's how I'm going to tie this thing together today. The CPI rose in May, 2.4% on an annual basis. It was a little bit lower than what had been expected, but it's a zero point 0.1 higher than last month's numbers. And of course, the core, which strips out food and energy, rose by 2.8%. Was again just a little bit below what was forecast by economists. But then when you dig in, and again, I love to dig into this stuff. I don't want to just read the headline. I want to know what makes it up. What really made up a little bit of this dip was inflation rose less than expected in gasoline, and lower energy prices were a major source of de-inflationary or deflationary pressure. Now, that was eaten up by several things. Shopping in clothing and apparel dipped a little bit, but what offset that was price hikes on some grocery items, as well as housing costs. And we just talked about the price of housing nationwide is up 1.4% year over year in single family. Rents in apartments are also up. Rents on houses are also up. So I can see that is right in line with what they're talking about here. The other thing that went up was beef. And you're going to see beef climbing for quite some time. As some of you may know and others don't, we own a meat processing plant in Central Texas. And I can tell you, I watch cattle herd very closely. And we are currently at less cattle in the United States than we had in 1970. That is, less cattle are being raised right now in the United States than we had in 1970, although we have millions and millions and millions more in population. I used to know what that number was. I'll let you look that up because I don't want to quote something incorrectly. But you're going to see cattle prices climb. And that is borne out in this CPI report that cattle and all beef prices, rather, have climbed. And now we have another issue with beef in Mexico, which is one of our big import places for beef. Why we're importing beef from Mexico, I have no idea, but we are. And but right now they are dealing with something called the screw worm. And that is something that is really decimating their cattle herd. And we have a moratorium now on any Mexican cattle coming across the border into Texas. Or anywhere else across the border, that is. But Texas ranchers, I can tell you, that are close to the border are really, really nervous about this screwworm making its way north. It started actually in southern Mexico, and it has been migrating north, and Mexico has not been able to stop it or get it under control. So our USDA is hoping that working along with the Mexican government, they can stop it from getting into the United States. All of those things are going to drive beef prices for the foreseeable future. So just a little tidbit there on that. But here's the thing that I wanted to get to in this report. While inflation remains far lower than during its post-pandemic spike, when it reached 9.1 in June of 22, it's still higher than the Fed goal of getting it down to 2%. So because of that, here we go. Wall Street expects the Fed to hold off on cutting rates until later this year, with economists polled by FactSet giving a 100% probability that the central bank will keep rates steady at its June 18th meeting. Now, I am recording this June 11th, so that is exactly 7 days from now. And there is a 100% probability, according to traders on Wall Street, that the Fed will leave rates alone. And I've been saying this for years. I do not believe the Fed can lower rates right now. And I said it again on podcast number 3. I don't think they're going to lower them. And if they do, it will be a very unmeaningful lower. In other words, just a window dressing. Might lower a quarter point or something throughout the third quarter. But you're not going to see anything meaningful. Now, here's the spin I mentioned earlier. Economists are also keeping a watchful eye on when Mr. Trump's tariffs, which he has imposed on, underlined, almost every nation on the globe, will show up in the inflation data. Now, this is key. This is what you are going to read. I don't care if it's Fox News, CNN. This one happens to be CBS. It could be Wall Street Journal. It could be Bloomberg. It does not matter what app or what news organization you go to. This is how it's being set up. It is being set up by the entire national media that Trump's tariffs are going to raise your prices. You need to expect that. You need to expect that Trump's tariffs are going to raise your prices. Now, let me go back to what we talked about earlier. What we talked about earlier on the Bigger Pockets article. Why? Why have transactions, why have sales of homes fallen? What were the things that were recited in the Redfin report? High prices, high interest rates, and, yep, you got it, tariff and recession fear. Well, where the hell do you think all this fear is coming from? Where's the fear coming from? It's coming from the media. It's coming from every single news organization across this country saying, expect prices to go up, expect them to go up, and it's Trump's fault. It's the tariff's fault. Now, I'm going to provide what I think is going to be a persuasive argument that prices are already going up way, way higher than what people think they are. So let's talk about an article that was pulled from the Wall Street Journal on June 4th. And the title is Economists Raise Questions About the Quality of U.S. Inflation Data. Now, this is, I'm shocked. Okay. I'm being sarcastic here. I am not shocked. I'm just shocked that it took so long for economists to raise questions about the quality of U.S. inflation data. Labor Department says staffing shortages reduced its ability to conduct its massive monthly survey. Guys, you couldn't make this up. If I gave you a month to come up with the most preposterous story, okay? So think about this. Economists on Wall Street are starting to question the Labor Department over the quality of U.S. inflation data. And the Department of Labor says what? They say, it's Trump's fault. It's Trump's fault. I mean, why wouldn't they? Everything is, right? So here is their explanation. Again, I couldn't make this up if I had a year to try. To calculate in the inflation rate, hundreds, with plural, hundreds of government workers called enumerators fan out across cities each month across the nation to check how much businesses are charging for products and services. Now, I'm sure in the modern day age, where we have these things called the internet, where we have AI, where we have some of the technological tools that we've had for 30, 40 years, some of them, this has got to be the most efficient way for the Labor Department to find out whether prices are going up or down and by how much. Because In reality, is that not what the CPI is supposed to do? It is supposed to tell us how much a basket of goods and services costs relative to what it used to cost. So hundreds of enumerators, I suppose, climb on airplanes on a monthly basis and fly all over the country checking on the prices of blue jeans and accounting services. Those are the two things they mention in their inquiry here. Now, then, once they get these prices and they come back to the Department of Labor, statisticians roll those figures together into something called the Consumer Price Index, or CPI. You can't make this up. All right. When I read this, I couldn't believe what I was hearing. I had to understand if this article was from 1953, right? I could understand that's how you would do it in 1953. But now, oh my goodness, okay? The government enumerators can't track down specific prices if the government enumerators can't track down specific prices in a given city, they then try, oh, I love this part, to make an educated guess. So what is the CPI? Well, it's an educated guess by enumerators. And they base this guess on a close substitute. So say they can't get a price on slacks, they'll get a price on cargo pants instead. Wow. Okay. Those of us that are in real estate, we understand something called comps. A comp is kind of what they're talking about here, a comparable. And I don't see cargo pants as being a comp to slacks. I'm sorry. It's just not comparable. Okay. So if they can't get the comps that they're looking for, could you imagine an appraiser going out and doing an appraisal on your single family home, and they come back to you and they say there really weren't any homes like yours, so we just guessed. We found a couple mobile homes that were close by and we used those instead. Yeah, I'm sure that's going to work. Now, they go on. But in April, with fewer workers on hand to check prices, statisticians had to base their guesses on less comparable products or other regions of the country. And this I love about government, if nothing else. They could make up a name for anything, okay? Here's their name for this. It is a process called different cell imputation. Different cell imputation. Now, this is like transitory, which is what we were told inflation was, or mostly peaceful, which is what the protests up in Minnesota were a couple years back. But this is different cell imputation. I'll never remember that because it doesn't make any sense. And they had to use this in April much more often than usual. So it's usual to use it, but we had to use it a lot more often. And why? Because of Trump's hiring freeze, they can't hire more enumerators. So we're having to turn to less effective methods to fill in the blanks, said Omar Sharif, an economist at advisory firm Inflation Insights. He said he has been busy with calls from professional traders who make bets on inflation in financial markets who are anxious about the data's accuracy. Wow. Now, how important is this CPI? Well, the inflation rate determines how much Social Security benefits go up every year. It also determines where federal tax brackets are set. Private sector contracts, such as wage agreements between companies and unions, usually reference the inflation rate. Payments on $2 trillion of inflation protected federal bonds hinge on the inflation rate, as do yields on standard treasury bonds. So, it's kind of a big thing, right? It, it's not nothing. It's not just some little thing that really doesn't matter. It's a huge damn deal. But we're guessing and using different cell imputation much more often than usual. Interesting. Wow. Federal government, right? So we see now that in yesterday's report, the CPI went up, whatever they said it went up, 2.4% on an annual basis, and the less volatile, which is what every news agency will say before they tell you it's the core, which strips out food and energy, it was up 2.8% over the last 12 months. How many of you believe those numbers? That I'll just pose it that way. How many of you believe, with your own eyes, with your own wallet, with your own bank account, how many of you believe that prices have only gone up between 2 and 3% over the last 12 months? I'll just pose it to you that way, because I would argue there's no damn way that that's all that's gone up. There's just no way. Well, it depends. I'm from Appalachia, and there's a lot of funny sayings from that area. One of the funny sayings I learned growing up was, figures don't lie, but liars sure can figure. And that is to say that somebody that is shrewd, cunning, deceptive, use any word and as aggressive as you want, but somebody that is trying to manipulate can use figures to manipulate. Okay? They can use figures to lie, even though figures themselves don't lie. How do you calculate things? That is what we need to look at. So I was interested in, what is inflation today versus inflation of the 80s? Because if you hear anybody at my age or older, we'll talk about the inflation of the 80s, the early 80s, 81, 82. Inflation was sky high. Interest rates, you heard me say on episode 3, back then, the 30-year fixed, it was not uncommon for people to pay 16 to 19% for a 30-year fixed rate back then to buy a single family home. And we know inflation back then was 14, 15%. So Jimmy Carter, got the blame for most of that. And everybody talks about, man, the Carter years, they were the worst. And boy, even though we hit 9.1 a couple of years ago for inflation, it still wasn't as bad as the Carter years. Well, it depends on how we figure, doesn't it? You see, we don't look at CPI the same way. We don't look at inflation in this country the same way we did back in the 80s. We have changed the way inflation is calculated several times since the 80s. Now, one of the things that we do today is we don't use a static basket of goods and services. That's the way we did it back in the day. There was a static basket of services that said, this is something a lot of people use. Most people use these things. So we're going to look at the price of these things every single month. And we'll report whether those things are going up or going down in price. That shows us inflation or deflation, and by how much, right? But see, now we are so much smarter than we were back then. We don't do it that way anymore. What we do now is we calculate things taking into totality human nature. We're so much smarter. What does that actually mean? Because to me, that's just a bunch of fluff. Well, here's what it means. It means that we take into account human nature changes. In other words, we might have said back in the day that we are going to use canned corn in this basket of goods to calculate the CPI. And we look at, I'm just making up things, Jolly Green Giant, canned corn. And we look at that same can of Jolly Green Giant canned corn every month. Now we don't do that. Now the CPI assumes customers will switch to cheaper alternatives when prices rise. So it may not be logical for us to look at Jolly Green Giant every month, because when inflation starts to go up, we should probably substitute Jolly Green Giant with the private label corn at that same store. What? I'm reading word for word here. What are you talking about? You're going to substitute the brand name for a private label. But yeah, that's what we do now. That's what these enumerators do now, is if the prices are going up, they assume that they can read your mind and my mind, and they assume what behavior change we're going to make, and they're going to now substitute the high-priced or brand name for a private label. And you know what? If inflation keeps going up, they're going to assume we're going to stop going to that store and we're going to start going to a cheaper store and buying their corn. Does this make sense? Does this make any sense at all? Read it for yourself. Read it for yourself. This is how inflation is calculated in this country. Now, if you want to know, now look, to me, I want to know this particular product, this particular basket of products, if we're going to keep calling it that, it cost us this month, and that same basket cost me this month. To me, that tells me how much the prices are going up. Making these assumptions and changing, this is liars sure can figure. This is liars manipulating numbers to make things look better than they are. There is no other logical reason for this nonsense. None whatsoever. They do the same thing with housing. They use something called owner's equivalent. And then they weight the CPI using different weights for different categories to make the numbers come out the way they need them to come out. Now, if you want to know what the real inflation rates are, you could go to some place called Shadow Stats Index. And what Shadow Stats does is they'll show you using the 1980 computation. They'll show you using the 1990 computation, and then they'll show you using the current computation. So you can actually look at all three on a graph and see. And basically, I glanced at it today just to see what this 2.8 core or 2.3 overall CPI is, and what that would have looked like in the 1980 computation is somewhere around 10%. So prices have not only gone up 2.4% or 2.8 core, they have gone up roughly 10% if you compared apples to apples. If you compared the same basket of goods and services back then or a year ago to what you would compare it to today. So if you're a geek on this stuff and you want to dive into it, like I do, it's interesting. It's fascinating. But I say all of that to say, don't read these numbers like they're gospel, because I don't believe they are. I believe that inflation is way higher than 2 or 3%, which is what they're telling us it is. And if you go to Shadow Stats and look at the old computation where you're comparing apples to apples, month over month and year over year, it bears that out. What I do believe, though, is with inflation as high as it is, we are not going to see interest rates drop anytime soon. And I know that's bad news again for all my real estate friends, but it is what it is. You cannot reduce rates and create more demand without creating more inflation. Okay, that's how it works. The Fed knows that. They know how these numbers are set up. They know how they are calculated, and they know what the real inflation factor is, although we just don't call it that anymore. So rates are going to stay the same. That's my prediction for next week. If they were to drop, it would be a nothing of maybe a quarter point, and you won't see anything else maybe the rest of the year. But I don't think we'll even see a quarter point. I think the president will stomp up and down when it doesn't drop, and he has to do that. He has to make it look like he wants that to happen, and maybe he does. Maybe he doesn't understand all this. I don't know what he does understand and what he doesn't, but I believe that they will leave it alone, and I believe they should, based on the numbers as they are and not how they are being reported. So that is inflation. That's the deep dive on inflation today. Hopefully that didn't go too deep on anybody and lose you in the details. But we'll be back again next week with another market update and all the latest in the news as it pertains to real estate investing and alternative investments in particular. So hopefully this was helpful to you. And if it was, tell your friends. We just launched live this week. We've had tremendous feedback so far, so I am very encouraged by it, and we're going to keep on going, and we're going to make this one of the top 10 in the investing category in podcasts. Thanks for joining us on The Invested Mindset. To continue receiving actionable wealth building strategies, subscribe on Apple Podcasts, Spotify, or wherever you listen to podcasts. Turn on the auto download to ensure you never miss an episode. And if today's insights moved you any closer to financial freedom, please take a moment to leave us a rating. It helps fellow entrepreneurs and investors discover these valuable strategies. I'm Tom Berry, and I'll see you next time as we continue building the path to lasting wealth and freedom.